stock market is not behaving so well so far this year. I'm looking at a screen here. It says global equities are down roughly 15% year to date. The tech sector, the Nasdaq, down almost 25% year to date. I want to find out if it is now the time to buy the dip. I'm joined by Sonal Krishnan. Let's start off with what exactly is happening. Why are markets down so sharply so far?
Well, if you think about the biggest headline of the year, it's probably been the Russian invasion of Ukraine. And we've talked about that in this series before. I mean, in addition to the humanitarian aspect, there are big economic consequences for Europe. But actually, if you take a global view, it's probably what's happened in inflation and interest rates that's the biggest story. So it's not just, for example, an issue for the US market. I mean, if you look at Asia, for example, central banks haven't moved rates, but you've still seen weakness in the stock markets. If you look at the bond market or the currency market, again, still reacting to this story. I mean, worth putting this into context. A year ago we had 0% interest rates here and in the States. Now we're looking at rates more like 1%. And by the end of the year, I think most participants think that it'll probably be closer to 2%. So central banks having prioritized growth for most of the last 20 years, now having to prioritize inflation, even if that actually hurts growth a bit.
Is that the reason why the tech sector has suffered more than the broader market?
Well, it's kind of worth thinking about what's different about the tech sector. And so some people have said, well, that more of their earnings are supposed to come in the future. So how you discount those with your choice of interest rate matters. I almost think it's a bit simpler than that. Investors now have more choices about where they can get investment returns. And so they're looking at these parts of the market that have the highest hurdles to clear in terms of delivering profits in order to meet expectations, and just wondering about whether that's going to happen. And then if you throw into the mix that looking at the last earnings season, disappointments from Google, really big disappointment from Netflix, and investors just saying, I'm not sure they're going to deliver, and the valuations therefore can't really be justified.
Yeah, and I mean, some of those names have taken quite a hit this year, but I mean, there's a point at which they become good value. There's a point at which we hit the bottom of the market, and there's a point at which we'll see a recovery. And I guess my question is, are we at that point?
Well, I think trying to pick a precise bottom or a precise top is always really difficult. And generally when investors, and I think about my own experiences here, really try and say, right, the market's been down, so I'm going to take some money out, or I think today might be the day, it's generally a recipe for losing money. And I think a lot of advisors will know that the best advice they can give is just stay the journey. If the advice and the long-term strategy were right 6 months ago, then they're probably still right today.
Wise words, absolutely hold true, but we're not letting you off that easy. You obviously manage portfolios, and your team manage portfolios where you do take active decisions in some of them. And I'm interested. I know they're not day-to-day decisions. I know these are with a longer term view, but I think it will be interesting to hear how you're actually positioning those portfolios.
Oh, I thought I'd got away with it. I mean, if I think about where we are in portfolios today, I mean, we are actually slightly overweight at the equity market, but there's a real focus for us on being selective and trying to find areas of earnings resilience where there's not too much dependence on a really buoyant or accelerating economy. I mean, I'll give you a couple of examples. In the healthcare sector, US healthcare is an area where we've got positions, and historically that has been quite a stable grower in terms of profit, not too dependent on the economy. And if you add to that some newer developments, I mean, coming out of a pandemic, lots of developments in terms of healthcare technology and a stronger relationship with regulators. For us, that's quite an interesting area. But equally, if we look more in the kind of the old economy as well, looking at the energy sector, we've got investments in European energy companies. And what's interesting there is the energy prices have been so strong because of real kind of constraints in terms of supply. And that's actually allowing those companies to meet investment challenges, like how are they going to decarbonize and reach net zero, but at the same time also deliver returns to shareholders. And for us, that's quite an attractive combination right now.
Okay, really interesting. Some good ideas there. I guess what I'm hearing is you're not quite ringing a bell at the bottom, but you are finding opportunities, which I think is positive. I mean, Sonal, we will be back next week. We will put a fund manager on the spot. It may or may not be you. We'll see how we go. But we will put the hard questions to the fund manager. We will look to do it in around about 5 minutes. Until then, see you next week.